Hello.
Hi.
Well, okay, it's 6:30, so let's get started. So we will start with Deskimir case that you had as a quiz for the last session. And let me open, maybe I'll use one second. Start demonstration. Okay. So for the beginning, let's discuss this Deskimir case. You were supposed to post your opinion on the value of or the price for Deskimir shares, and you should decide it, is it overvalued, undervalued, or fair valued, and to do that with DDM model, with discount dividend model, you would use three sources of information, three parameters. First is its dividends, second is growth rate, and third is discount rate. And let's look at a possible model for Детский Мир that we could use to value it. So the dividends, they pay dividends twice a year, roughly twice a year. In 2020, it's a bit unusual because in recent years, they pay dividends twice a year after 9 months and after the full year. In 2020, they paid after 6 months and after 9 months, if I remember correctly. So we can expect that they will pay something more, but we can use now 2020 as we have it in the history. And for my calculation, again, just like I did it in the last lecture, I use average dividends for the last 4 years. And I don't try to say that this is the most correct approach, but we should do something. We should do something with the information we have about the dividends. And for 2020, they have less dividends. 2 years before, they paid more. So with this average dividends, I would probably have something more stable and more usable for the future, for the forecast. But this is a very simplistic approach. So we don't try to say that this is an accurate valuation for Детский Мир. So we have the dividends. We calculate average dividend per year, and then we apply for Gordon growth model. We can apply 4% growth, for example, and 10% discount rate. And with 4% growth and 10% discount rate, we get price 135, which means that Детский Мир is slightly overvalued because their current price is 150, but not too much. If we believe that the discount rate should be 9% with the same growth rate, then the price would be 160, and that means that they are slightly undervalued. If we at the same time believe that their growth rate would be like 5%, then the price would be 200 rubles, and that means that they are very undervalued. So this is the math that we can do. But with this math, didn't we have 1050 in 2020? I don't think so. Let's check it. That was in our last lecture, 2020. Now, what I can see here is about 7.6, right? Yes, I mentioned that. They still didn't pay. They didn't pay for the last year, for the whole year. And by the way, you mentioned a very important thing, I believe. You said you couldn't use Icon. And yeah, that's fine. We will not use Icon for your Volkswagen case or for all other cases we use throughout the course, because Icon is a very convenient and good tool when you need to search quickly through the whole market information and find something relevant or important for you. Like, for example, if you need quickly to collect information about some similar companies, to find for market-based valuation for comparables, to find 5 or 10 comparable companies quickly in 5 minutes. In this case, Icon is an ideal tool for you. But for things like this task, when we know the company we're going to analyze, the best way to collect data about the company, I mean, financial reports, things like dividend payments, and so on, there are the best source of information is always investor relations part on the website of the company. They are these sources of information are usually the most detailed. They are always the best for this company, because in Icon, for example, for financial reports, sometimes they try to use one and the same structure for financial reports of all companies. And because of that, for some companies, you get a bit distorted financial report. So, well, a question, can we use data for dividends that paid during the last 20 months? No, it is not a correct approach for this case, because in this case, for last 12 months, you can capture dividends not for the full financial year. You can see that they have an uneven schedule of payments. So you could get in your selection, you could get, for example, dividends for 1.5 years. So you should be careful with that. With all the others, you can use it. Yes, and exactly in this case, look, you take 3 payments, and those 3 payments are for the complete 2019, for 2020, and for half of 2020 and 9 months. And the question is, with this change in schedule, do we have a full financial year, or maybe it is for incomplete year or more than 1 year? So you should be careful, and average dividend would be better for this calculation. But what's interesting in this case, mathematically, of course, you can easily calculate it this or that way, and the only problem is how to select correct dividends. And for most companies, this is a bit complicated case because of their schedule of payments. But for most companies, they pay dividends once a year, so you can easily calculate their annual dividend and apply it to your case. The problem here is not with the dividend. The problem is with other assumptions. First, your discount rate. With your discount rate, you can change your valuation a lot. Discount rate has huge importance for the final result of your valuation. And you can go to a very high numbers if you set low discount rate, or you can get a very low valuation if you set your discount rate higher. So the discount rate is of huge importance because it's in our calculation formula subtracted by growth rate. So even change something from like 9% to 8% gets us to much higher valuation, because actually we have in the formula 9 minus 6% or 8 minus 6%, and the difference is quite huge. So the discount rate is a big question for our formula and for our valuation. So the discount rate will be the topic for today. And today we'll discuss this required return on equity. And the next lecture will be about going deeper in our analysis, because the other problem for us is that we have those dividends paid by Detskiy Mir, but we understand that dividends paid last year don't define the dividends that will be paid next year, in 5 years and 10 years. We discussed last time we discussed one step further from the dividends paid last year to net profit and dividend payout ratio. And with net profit and dividend payout ratio, we can analyze a bit deeper our expectations about the company. 1 second. During modeling through DDM, how analysts usually use data from about particular years? Dividends, usually we have dividends in the most simple case. We get dividends for 2020 about May or June in 2021. So we have 6 months difference between the year that we use in our analysis and the moment when we paid those dividends. And we can ignore that. Mostly, in most cases, we ignore that unless we involved in some technical analysis, so that we actually calculate not long-term valuation for the company, but short-term changes in share price to trade quickly now based on that information. But for long-term valuation, for fundamental valuation, we ignore this fact, and we believe that the last financial year is the dividend paid by the company. And actually, this is something that in fact happened. Because if we know about the results of the last financial year, that means that we have the financial report from the company. And that means that we have, like, we now in May or June of the next year, sometimes in April of the next year. And when we decided that the dividends today, that the dividends paid for 2020 is something that paid yesterday, because we just received the financial report. This is actually what happens, because yesterday or today or next week or next 2 weeks, we'll get those dividends. In the scale of a year, that looks like now. And the next dividend will be a year from now. So we can use that as D1 in our formula, so the expected dividend for the next year. But all those calculations, of course, quite rough. And this is not a big problem for us, because the whole method is very rough. So to get deeper in our analysis, we should go from net profit and dividend payout ratio to the factors, to drivers that drive the net profit. And those factors are expected revenue, cost of sales, investments, inflation, currency rate, taxes, and so on. So after we discussed today the cost of equity, a required return on equity, The next lecture will be discussing the full-fledged financial modeling, financial forecast for the company. And instead of calculating dividends based just on the history of dividends, we'll be calculating expected dividends or something that we'll be using instead of dividends based on what we expect for the whole business of the company. So this is our plan for the next lecture, but now let's postpone it. So before we start discussing discount rates and required rate of return for equity in our case now, let's mention some very important things about cash flows and discount rates used to discount this cash flows. Imagine the company, the business. What this business consists of? This business consists of three big parts. If we look at its balance sheet, then its balance sheet always consists of three big parts. First is cash. And although there are some special conditions where cash on the accounts of a company, of a firm, is valued not exactly equal to the amount of this cash, but for most cases, cash is just cash. If the company has 1 billion rubles in cash on its bank account, then we can count it as 1 billion rubles in its value, in the value of the company. Second part is the operating assets. Everything that the company uses to do business. And those operating assets can be valued by DCF model, by discounted cash flow model. We discussed that last time. If we use discounted cash flow or discounted income approach, then we declare that for our valuation, the value of the company will be equal to all future cash flows, free cash flows, all future income that we can get from this company based on our expectations and some discount rate that we applied to this expected income. And the last part of the value of each enterprise, each company, is non-operating assets. Sometimes companies own something that they don't use in their daily operations. I can give you an example. I had a case of a company. The company was a special retail chain of shops and canteens, cafes, things like that. But so you can analyze its business based on the expected cash flows, expected operations of this company. But in addition to that, on the balance sheet of this company, there was 25% stock of a bank. And of course, this bank is not a part of the business of this company. They didn't use neither shares of this bank, nor this bank as some operating asset. Just for some reasons, somebody put these shares on the balance sheet of this enterprise. So to value this company, of course, you calculate expected cash flows from its business, discounted, and you get operating assets. And then you add this not operating asset, the value of bank shares. Or in most cases, for valuation purpose, this part of business is separated from the main business. And in most valuations like this, we have two values for non-operating assets and values for businesses. So this is from on the asset part of the balance sheet. So the value of the company consists of cash, operating assets calculated based on DCF model, and some non-operating assets. And who owns that? Who owns this company? You can say that the shareholders own that, but no, not exactly. There are four types of owners of every enterprise. Not every enterprise has all four types, but generally speaking, there are four types of owners. First, we'll start from the bottom, is equity. So equity holders are the shareholders of the company, those who formally own the company and who manage the company, and they are holders of the company's equity. But not the whole company is financed by equity. The next big part of every business is debt. Debt that comes from bank loans, bonds, and even sometimes accounts payable. And those debt holders, they also have claims against the company's assets. So they're not the owners of the company in terms like equity holders, but they still have their claims for the company assets, and that means that some value of the company goes to them. So for the valuation purpose, the company is owned by equity holders and debt holders. And there are two other possible types. The company can have minority interest. Minority interest appears when you, for example, bought 90% of some other company. When you buy 90% of a company, you show on your financial reports, on your balance sheet and income statement, you show all 100% of its business. But we remember that 10% is still owned by your minority shareholders. So you write their part, their claim against what you presented on your balance sheet as minority interest. And the fourth possible type of owners of the company is the holders of preferred stock. Preferred stock is something between debt and equity. It has many features like equity, but you should pay a fixed interest rate just like for debt. So they are not exactly the debt and not exactly equity. And with this idea of several types of owners of the company, we'll be discussing two major types: equity and debt. Two others just for general view. So with two types of owners, when we value a company, when I say that this company has value 1 billion rubles, what does it mean? Does it mean that I can divide this number by number of shares outstanding for this company and get the share price. No, this is the enterprise value. And this enterprise value is owned, is controlled by debt holders and equity holders. So there are two possible definitions of the value. First is enterprise value, and enterprise value is owned by debt and equity, right? And the second is equity, and equity is equal to enterprise value minus debt. And in valuation, sometimes we calculate the value of the whole enterprise, and sometimes we calculate value of equity. Next lecture, in the next lecture, we'll be discussing two types of free cash flow used in valuation. The first is free cash flow to the firm, which is what the whole company earns to pay to those who own this company. And we just mentioned that two types of owners control the company: debt holders and equity holders. So free cash flow to the firm is something that company has after it paid its costs, investments, taxes, but before it paid something to debt holders or shareholders. So free cash flow doesn't include interest paid, for example. And with free cash flow, we can calculate the enterprise value. And free cash flow to with free cash flow to the firm, sorry. And the second version is free cash flow to equity, which is free cash flow that remains after everybody is paid except the final receiver of its profit, the shareholder. So for free cash flow to equity, we subtracted interest paid, and we have just cash flow available for our shareholders. So what's important here? The important thing is that when we analyze free cash flow to equity, which is here, then the discount rate for us is cost of equity or required return on equity, because here we analyze what shareholder gets from this investment. But if we analyze free cash flow to the firm, if we calculate the enterprise value, not equity value, then the discount rate here will be not cost of equity, but what we'll be discussing the next time, weighted average cost of capital. And this weighted average cost of capital is a mix of cost of debt and cost of equity, because in this case, we analyze the value of the whole enterprise and return from the investment into this enterprise is a mix of investments of debt and equity. So the first thing you should remember is that the discount rate you use always linked to the type of cash flow you have. Now I have a question. Could somebody answer? If we use DDM model, discounted dividend model, what kind of return, what kind of discount rate we use? Should it be return on equity or weighted average cost of? Oh, yes, of course, because dividends are what shareholders get. That's why we started with return on equity. Okay, the next important thing you should remember is currency and inflation used in your calculations. Your currency and your inflation approach used in your forecast, in how you created cash flows for discounting, should be the same as included in your discount rate. And there are two basic considerations in that. First is, of course, it's quite obvious, I think, that the discount rate you use to discount your cash flows should be for the same currency as your cash flows. You cannot apply a discount rate for dollars to cash flows in rubles, and vice versa. So this is the first thing. The second thing, and this is more tricky part, is that you should never mix nominal and real cash flows and discount rates. If your cash flows are in nominal prices, that means that in your growth rate, you have not just real growth you expect for this company, but also inflation. If you build a full-fledged forecast, then in this full-fledged forecast, you should have inflation rate that applied for all future cash flows. That gives you nominal cash flows. And for nominal cash flows, we use nominal discount rate. And usually when we use some numbers as discount rate, as expected return on something, and so on, we in most cases we use nominal numbers. So for most cases, for most models that you build for companies, nominal prices would be the best approach, just because in this case you use interest rates, return on equity, or other cost of capital presented in nominal terms, and nominal terms are the most natural way to talk about interest rates, about rates. But the other possible approach is real prices. If we use real prices, that means that in our forecast for our future cash flows, we don't use inflation. We always believe in this case, or we model our cash flows as if there's no inflation, as if the prices are the same for today and in 10 years and so on. That gives us real prices, real cash flows, and for those real cash flows, we use real interest rates. These are two important things you should always remember about discount rate. You should never mix the discount rate for the firm and for equity, and you should never use discount rate for nominal discount rate for real prices and the opposite. And with that, I will skip this slide. With that, we can go to the idea of our cash flow. The last thing here is how these real prices and nominal prices, or real discount rate and nominal discount rate, are linked to each other. The simple version is that just real discount rate is equal to nominal discount rate minus inflation. But if we have a model, that this simplified calculation is just for quick calculation of the discount rate. But if we have a model, so we can build any formula we need, or if we want to calculate it more accurately, then the complete correct formula is that real discount rate is equal to 1 plus nominal discount rate over 1 plus inflation minus 1. Because they not added, they multiple. So now let's discuss what is the correct required rate of return for equity. We used like 10%, 9% in our discussion. We could use in other cases like 12%, sometimes as 15%. Why it's 10, why it's 9, and what theory supports our opinion. So let's begin with some assumptions used. We will start with some fundamental theory now. And I believe actually that you learned this theory before in other courses, because this is a topic that circulates from one course to another. It's used everywhere, so you probably saw that. But anyway, we'll discuss it once again and apply it to our needs. So assumptions behind the most important theory for required rate of returns are the following. First, the investor is generally speaking risk averse, which means that the investor always requires higher return for higher risk. The second, investor can invest in risk-free bonds, which is more or less true for the markets like United States, where government bonds, treasury bonds, T-bonds, T-bills are roughly speaking risk-free, or the risk for them is so small that we don't count it. Third, any security is described by the expected return of this security and the risk. And the whole risk of a security is measured by the standard deviation, which means that we believe that the distribution of expected returns is normal. And of course, this is not always the case. You can guess that. But for the analysis, just to build the theory, we use this assumption. And the last two assumptions is that investor can invest both in positive and negative number of shares, which means that we can short sell all shares that we are analyzing. And the investors, all the investors on the market, have full and equal information about expected return and risk of securities. And of course, that's not the case for real life, but we just don't analyze issues of information about the company in this theory. And by the way, before we go further, I'd like to ask a question. Do you all believe that investors are actually risk averse? So that investors actually require higher return for higher risk? Could you comment on that? So all the answers was not really, not all, and that's true. That's true. Actually, for cases when the group answers yes, I had a question. I'll tell that now, but I think that with your answers, we can just mention this question. Imagine that you have two options. The first option is an investment where you invest 100 rubles and then you get back 90 rubles. So you have 100% guarantee of 10% loss. And the second investment is that you invest 100 rubles and then with 50% probability, you get back 70, and with 50% probability, you get 110. So the expected return is the same, minus 10%. But in this case, you have probability of getting profit, and of course probability of getting more loss than in the first option. Just think a second, what investment would you choose? The first one or the second one? When I asked this question to different groups of students, I got something like 80% to 90% of all students chose the second option, because they explain the second option still gives you some chance of getting profit, and the first option is just certain loss. And this is quite a funny case, because they chose the investment with the same expected return but higher risk. And this is important thing about the risk. Risk in our analysis is not just chance of getting lower profit or loss. Risk is any statistical fluctuations from the expected return from our investment. So we can measure risk yes, the question was, are both bad? Yes, they both bad, but you have to choose one. So in this choice, people choose the one with the higher risk, because in this higher risk, they saw some chance to get profit. You will choose cash, but you didn't have this choice in this question. And this is what happens sometimes in life. You don't have a good choice. You just have a selection of different bad choices. Okay, so if the risk is just a statistical fluctuation, then we can measure this risk, and this risk is measured for our based on our assumptions, is measured by standard deviation, which is a standard approach for normal distribution. Okay, now we have several shares or several securities, and all those securities are described by expected return and standard deviation, and they all have normal distribution of possible profits. This chart shows us what happens when we have just one security. But what if I know, another assumption is that we know exactly the expected return and standard deviation. So we know the risk and we know the expected return. What if instead of one security, I have, well, let's say 3 securities. With those 3 securities, I know something like in this case that the first security has expected return 4% and standard deviation 5%. The second is 6% and 4%, and the third is 8% and 8%. And I can combine those securities in any mix. What will we have? What will we have as the result of such combination? I'll show you that in real time. So here is a model where we have these 3 securities. Here they are. And now I will start 5,000 counts of random combinations of those securities. So we will create 5,000 random portfolios. And let's look how those random portfolios will distribute on this chart. Here we have the risk standard deviation on x-axis, and y-axis is required return, expected return. So we launch generation of those portfolios. So this is random numbers. And now you can see how they distributed. And now let's look at this portfolio. What do you think about this point, for example? Will any investor invest in combination in portfolio like this? I would say no. Because if you think that this is about 11% in standard deviation, if you believe that 11% standard deviation is okay for you, then you don't need this portfolio, you need this one. Right? You will invest in this because this mix creates a better expected return for the same expected risk, for the same expected standard deviation. And that works for all combinations of those securities. So although we have a huge amount of possible combinations of different securities, actually we don't invest in most of them. So we don't need to discuss all those combinations except this line. So for any level of risk, we have a portfolio with the best expected return. And this portfolio, they all lay on the top part of this distribution, and we call it efficient frontier. So any combination of securities or shares in our portfolio has this efficient frontier, and we will not invest ever in other combinations. So instead of millions of combinations, we have now a smaller amount of possible portfolios. Now let's make one more step and we'll get just one possible portfolio for any market. Let's add to our calculations one more thing. As I told, in our assumptions, we have another assumption that we can invest also in risk-free bond, right? So we have now choice we can either invest in a combination of risk-free bond and some portfolio, some mix of shares, or just invest in other mix of shares. Now, let's say that we, on this efficient frontier, we chose this point, and we decided that we will invest in risk-free bond and this portfolio in different combinations with different ways, various weights. Is it an efficient approach? I don't think so. Because if, for example, we have invested in this combination, so we have some share in our portfolios, some share of these market securities and some share of risk-free bond, then we are inside this distribution of possible portfolios, but we planned to be here, right? So what portfolio should we use to always have the highest return for any risk? This portfolio is called tangency portfolio. This is the portfolio that creates between risk-free bond and this portfolio. It creates a line that touches our distribution in just one point, in this tangency point. So what we can see from this is that for all combinations of expected returns, expected normal distribution for securities, there is always one best mix of market securities that create the highest expected return for our portfolio. So the first thing we came to from this analysis is that there is an optimal portfolio, and the last step we need is to find it. We don't know where this optimal portfolio is. The line we created this way is called capital market line. So the capital market line is the line between risk-free bond and tangency portfolio, and we are always going to invest only on the capital market line. The formula, this is just the formula for this line, is that a required rate of return for our investment is equal to risk-free required return plus standard deviation of target standard deviation over the standard deviation of tangency portfolio times required return return of tangency portfolio minus risk-free return. But basically, this is just formula for this line. The problem here is that we don't know where this tangency portfolio is, and we don't know how to calculate this standard deviation for all securities that we analyze. And there is one more problem. The problem is that this standard deviation isn't that important for us, actually. And to explain that, let's go to a model again. Let's look to another calculation. Imagine that I have a security, and for this security, expected return is 100, standard deviation is 50. So relative standard deviation for this security is 50% of expected return, and it looks quite risky. So this is a risky investment, and I will probably require quite high return because I invest in risky asset. But what if I invest in two securities like this? With two securities, my expected return will be the expected return of the first security plus expected return of the second security. But the standard deviation is not the sum of standard deviations. It's sum of squared standard deviations and square root of this sum. So the standard deviation for two uncorrelated securities will be 71, and the relative standard deviation is 35% now, not 50. What if I invest now in 1,000 of securities, of different uncorrelated securities? You can see that relative standard deviation is just 2%. So I used risky assets, risky securities, but when I combined in my portfolio 1,000 on different securities, I got very stable investment. It's not risky. And because it's not risky, I can agree to much lower required return. Correct? Relative standard deviation is not a standard measure for statistics, but this is just something that I use here to show you the risk. So with relative standard deviation 2%, this standard deviation of 1,500 isn't very serious risk for us when we expect return of 100,000. But what if those shares are correlated, and their correlation is something like 0.1, which is quite low correlation. What correlation means? Correlation means that their statistics is not the statistics are not independent from each other. They don't hardly linked to each other, but their fluctuations interrelated. And because of that, we cannot create diversification by collecting those 1,000 shares or 1,000 securities. And what if their correlation is 1, which means they're absolutely correlated? We don't get any diversification. And with large portfolio and on security market, we can create a large portfolio with hundreds of shares, sometimes thousands of shares. With portfolios like this, we would ignore all the risks because we can diversify them away from our portfolio, from our investment, unless they are correlated. And in fact, of course, most companies are correlated somehow because they all depend on the market. They all depend on the same factors and drivers. And that means that actually correlation, not the risk as standard deviation, but correlation between this company, the company we are analyzing now, and possible other investments is the thing that the most important for us. And because of that, we change our approach to the formula, to the calculation. Instead of using, this we discussed, instead of using sigma, instead of using standard deviation, we say that, you know, actually the only thing we are interested in is correlation. And instead of standard deviation, we can use here a coefficient called beta. And this beta is calculated as correlation times standard deviation of the security we analyze over standard deviation of the market. So the formula will be changed, and now it's not the capital market line, it's security market line, and we get the formula that you probably saw before. Required rate of return on any investment in any security on the security market can be calculated as risk-free return plus market return minus risk-free return times beta, or we just write it as required rate of return is equal to risk-free return plus equity risk premium times beta. So what we can see now? Now we can see that required return for any investment requires from us three parameters. First, risk-free rate. Second, equity risk premium, which is what we pay over it on the top of risk-free return for the market shares, and beta. And beta is relative correlation between our shares, our security, and the wide market. So we just need these three parameters, and we can calculate required return for any security. Let's go to the first parameter, risk-free rate. For the risk-free rate, what we can call a risk-free investment. The risk-free investment should have two important characteristics. The first, it should have zero default risk. So we understand that what expected to be paid for this investment will be paid. There's no default for this investment. And of course, this sounds a bit theoretical, because for any investment there can be default. Any investment is somehow risky, but there are investments like government bonds that bear so little risk that we can say that they are risk-free. And there must be another feature of this investment. It should have no reinvestment risk. What reinvestment risk is? Look, for example, I have a time horizon for my investments 10 years. And I buy a government bond, 1 year government bond, and this government bond has 5% expected return. As there's no default risk, I'm pretty much sure that I'll get this 5% for this bond. But does it mean that my 10 years investments in government bonds are risk-free? can I be sure that I get my 5%, my expected 5% for my 10 years time horizon? No. Because in 1 year, this government bond will be repaid. And after that, I'll buy maybe the next issue of the same bond, but nobody promised that the return for the second year, for the next issue, will be again 5%. So there's reinvestment risk for the government bond, even if there's no default risk. So to make the investment risk-free for us, we should find something that first will pay for sure the money they promised, and the second, the time horizon for this investment should be the same as our time horizon for the analysis. And for the equity, what is our time horizon for equity? We actually have no limit. When I buy a share, I can hold it 20 years, 50 years, 100 years. So there's no limit. And based on that, we would expect that for our risk-free investment, we would try to find the longest government bond, right? But actually, no. We usually use not even 30%, 30 years government bonds. Instead, we use 10 years government bonds. And for risk-free rate in dollars, for example, the source of information for us would be very simple. We go to look at treasury yield curve, and on this treasury yield curve, we take 10 years government bonds, and this is our risk-free rate. Here, it's an older example in my presentation. So it's 2.33. It was in May of 2017. Now it's, let's check it. Now it's 1.69. So it's lower for today. Why 10 years? Why not 30 years, even if we have this available as our information? Because later we will use to calculate various risk premiums. We will use comparison between interest rates for treasury bonds and interest rates for corporate bonds. And the problem is that for treasury bonds, we can easily find 30 years bonds, but for corporate bonds, 30 years bonds are rare, and it will be just hard for us to find comparable corporate bonds to calculate our risk premiums and so on. So we just to make all our securities comparable, we stop at 10 years and we don't go further in time. So for dollars, our risk-free rate is 10 years T-bonds, treasury bonds. But what will we use for euro? For euro, we have different yields for different countries. They all in euro. In Germany, it can be like 0.5%. In Italy, it's 2%. In Greece, it will be 5%, and so on. What should we use of these bonds? The answer, of course, is in the definition of the rate we are looking for. We're looking for risk-free rate. And we understand that for Greece, for example, their bonds have 5% yield, not because of I don't know, of the country in general, but because of different level of risk. So in Germany, the risk, the credit rating for Germany is AAA, which means virtually no risk. And for Greece, it was it's not for today. Today their rate is different. For Greece, it's like B minus, so it's quite risky, and this is just not a good basis for us. So for Euro, the choice for us would be to find a country with Euro and with AAA credit rating, and use risk-free rate for this company or government bonds of this company. So for Euro, we have something like this. Again, this is not the current one. The current one is here. And we have about 0, slightly less than 0 today for Euro. Yes, that can happen, and that happens in our case today. So 19th of April 2021, it's minus 0.2%. In my older example, it was 1.4. Yes, Germany and Netherlands have different returns, but the difference is quite small. And you can choose the country you like. Maybe Germany is a better example just because it's bigger as the economy. Okay, and now what with Russia? For Russia, we have like today it's 7.26 as yield for 10 years government bonds. And of course, from the previous example, we understand that this is not a risk-free rate, right? But with Russia, we don't have another country with rubles and AAA credit rating. So with Russia, we should find another way to do it. And to understand why we got this 7% for Russia, and with this understanding, we will see how to calculate risk-free rate for Russia. We should think about what creates the rate for the government bonds. First element in this formula is risk-free rate, right? And we can start with risk-free rate based on dollar, for example. So we start with yield to maturity for 10 years treasury bonds. But why yield to maturity for Russian bonds is different? Because of two other elements. First, inflation premium. Because it's not dollars, it's rubles, and rubles have different inflation. We add inflation premium to this risk-free rate for dollars. And the second is country risk premium, because Russia, as bond issuer, is riskier than the United States. Investors require some premium for this additional risk. So we can go from one risk-free rate for dollars to the bond of Russian government and calculate and see if we understand those three elements. For country risk premium, there are different various approaches to that. We can use either default spread for government bonds or for corporate bonds with the same rating as Russia sovereign rating. And for Russia, current rating for Russia is 3B minus. And for this rating, corporate bonds usually have 2.54% higher return than the risk-free bonds. So we can apply this default spread from corporate bonds. That's why we used 10 years rates for the risk for the government bonds to compare 10 years bonds to 10 years bonds. Otherwise, we would add some noise to our calculation. Another possible approach is, by the way, is using interest for credit default spread. Yes, credit default swap. Sorry, CDS. CDS is a security used to hedge your risk against default of government bonds, and they have their interest rate added, the interest premium added for this hedge, and we can use this information. And with that, let's look how the current numbers look like. For ruble, official inflation forecast now is 4%. I mean, long-term forecast. For dollar, the most recent forecast was like 1 second. Well, I closed it. I closed. No. The most recent forecast was long-term was 2.1%. We can use this, although I'll answer that. Although it's up to you to believe or not to believe in any individual forecast. How many years we use? Indefinite. We just infinite number of years. We used infinite number of years for our forecast. And of course, this is something that we cannot actually calculate or prove. So just think about very long-term forecast, very long-term expectations, like 20 years, 30 years, at least 10 years. And you should use this long-term expectation in your calculation. And of course, it's hard to predict what inflation will be in Russia in 10 years and in the United States as well. But we do our best to have this forecast. Okay, so if we use ruble forecast 4% and dollar forecast 2.1%, then inflation premium is just the difference between those two, and that gives us 1.86% inflation premium. Okay, so with yield to maturity for dollar 1.69%, with country risk premium based on default spread from the previous table 2.54% and inflation premium 1.86%, we get something like 6.1% expected as yield to maturity for Russian 10 years bonds, which we actually had 2 months ago. Now it's higher, it's 7.3%, and that means that for today, either investors have higher inflation expectations, or they have higher expectations of risk, of default risk, and that's why yield to maturity for Russian bonds is higher than we calculated based on our risk-free expectations. But we still use this mathematics to calculate one from another, and we can use it in our analysis. Also, as all analysis like this, it has some errors, some fluctuations. So this is about the first parameter in CAPM model, in the CAPM model. The second is equity risk premium. And equity risk premium is something that the market charges on top of risk-free return for the risk, for the average risk of the market, or for the average risk of shares, of any average share on the market. So equity risk premium reflects two things. First, the nature of this security, the nature of equity, which is risky because you get profit, you get cash flow from your investment only if the company has profit and only if the company decides to pay this profit, and so on and so on. And the second is the risk of the market, because on different markets, companies have a different level of risk, and that, of course, influences the risk of their profits and so on. So this equity risk premium shows how much investors agree to be paid for the risk of equity. And what should you understand about this equity risk premium? We always analyze the past. When we analyze return, we call it expected return. We call it required return. But actually, the numbers we have, the numbers we analyze, are from the past. And because of that, the numbers that we can calculate based on hard information will always be about the past, but we apply them to the future, and that by itself creates some error in our calculations. So we have two possible ways to estimate equity risk premium. First, we will be analyzing historical data. With this analysis, we'll have a lot of information, a lot of data, a lot of reliable data, because if you have actual return companies or investors were getting from their investments during last, I don't know, 50 years or 100 years, you can collect this information. It's available. There's no uncertainty about this information. This is what actually happened. So we can do a lot of calculations. The problem is that all those calculations are not about the future. They are about the past. And it's actually hard to prove that this past will be repeated in the future. And the second approach is to use current expectations that we have about the market. With current expectations, you'll always have problems with the data because they are expectations. They are not what actually happened. And because they're expectations, they are not recorded very accurately. So you'll have problems with collecting this data. You will have problems with creating decent calculation based on this very poor data. And you'll have problems with proving that these calculations actually represent something that can be used in your analysis. But they have advantage over historical estimates. No matter how poor they are about the future. So they represent an attempt to build a future forecast, not the analysis of the past. So we can go one or another way in our calculations. With the past, here is historical data about equity risk premium from different countries. And you can see one mathematical problem with this data. Especially for, let's take Austria. Look, they collected from 115 years, and with this calculations, if we use geometric average, then for Austria we get equity risk premium 2.6%. And with arithmetic average for Austria, we have 21%. So from this example, you can see that the definition of average is very important in our calculation of, in our analysis of the past for this equity risk premium. And with this geometric average or arithmetic average, we can use a very simple thing. The idea, the approach that we use in our calculations, if you go into analyze historical estimates of equity risk premium, is geometric average, geometric mean. This is recommended by entities like CFA Institute, and with the case like Austria, we will not get strange numbers with our calculations. So it is not that fragile as the arithmetic average. But the problem is that you cannot prove it, because those who support the idea of arithmetic mean use the idea that, okay, in our formulas like DDM, we actually use a single period model. We don't calculate it from year to year. So if this is a single period model, then we can use arithmetic average for this model, and it could be applicable for the model. That's true. And another thing which is true as well is that arithmetic mean is simpler to calculate. So sometimes you can use arithmetic mean, but this is not the basic approach. The main approach for us is that if we analyze historical information about equity risk premium, then for each year we will calculate the return on equity, the return on government bonds, their difference, and this difference should be analyzed for a long period, like 30 years, 50 years, sometimes 100 years, using geometric mean. This is the basic approach. We will not calculate ERP, but we will analyze beta later using actual data. So the last thing that should be mentioned about this historical data on equity risk premium is that there are biases in how we analyze or how we get data on historical required return. Because with historical data on return, we usually use companies that work now, that exist now, and existed 30 years before ago or 50 years ago. And of course, if a company exists now and 50 years ago, this is quite a success. So this is a successful company. But there are other companies, the companies that had lower return, then they had no return maybe, or negative return, and they disappeared. And because they disappeared, they're not on our records now. We don't analyze their history. So when we see this return on equity for the last 50 years, this is actually the history of successful companies. And we excluded unsuccessful companies. And it's easy to say that we just have to include unsuccessful companies as well, but it's harder to do than to say, to collect all this data. Although there are tables, published tables with this data collected accurately for companies, and you can refer to these tables. So with that, we can calculate historical estimation. Now let's make a break. Okay, it's 8:04 now. Is 6 minutes enough? Okay, so let's go, come back by 8:10, and now we'll have a break. Okay. Yes, I'll share this file. I will post this file on Edu website. And yeah, and I have actually a couple of things about our LMS, because I saw a question from one student that your quiz for the lecture 1 is unavailable now. I will reopen it for submitting tomorrow. But the general rule is that the quiz for a lecture will be available the next day after the lecture, or maybe I'll try to make it immediately after the lecture. But today it's not available for the second lecture. It will be available tomorrow morning. So it's available for submitting the next day or after the lecture, and it's closed at 8:30 in the beginning of the next lecture. And all submitted quizzes, I'll check them, but after the lecture, and it will take usually 1 day to check all the submissions. Okay, lecture slides are available there immediately before the lecture, and files like this, like the file with efficient frontier, I post them after the lecture. It takes some time, not immediately after the lecture, but in the next 24 hours, everything we use in the lecture, during the lecture, will be available on the LMS. Okay, so some question. Oh, no. Okay, let's continue. So this is one possible approach, so to analyze the past, and to believe that this past will be repeated in the future. The other possible approach look a bit shaky, I would say, unreliable, but sometimes it works. There are two approaches mentioned by CFA Curricle. The first one is using Gordon Gross model to forecast equity risk premium. And in this approach, we just think about how people use the Gordon Gross model, GGM, to calculate value for shares, and use this formula in the opposite direction. In this idea, equity risk premium is equal to dividend yield based on 1 year forecast for the average market share, plus consensus long-term earnings growth rate minus current long-term government bond yield. And the idea here is very simple. Expected return is roughly equal to what we earn with dividend and what we earn with the growth. So the expected market return is dividend yield plus long-term growth rate. And equity risk premium is expected return minus risk-free return. So we subtract long-term government bond yield, and that gives us equity risk premium. Of course, that looks like science, but we have a lot of unreliable numbers here, because dividend yield is just for 1 year. It's not enough. We need long-term dividend yield, but we don't have it. And long-term growth rate is just consensus growth rate, which means what people believe. So this is not science, although we calculate it. So actually, in fact, in many cases, analysts go further and just do what again called on CFA curriculum as survey estimation. And survey estimation means just let's ask people what they want. And if hundreds of analysts set their required return for their calculations, at some level, we can say that, look, this is what market expects from the shares. So if the market on average expects that, this is required rate of return and required ERP. So this is actually the approach that used a lot in actual calculations, and sometimes the basis for our equity risk premium can be something like this. This is an example from some analytical reports of KPMG, and I used in my evaluations, I used things like that, and that was enough for many companies, for many cases, just to find a big market player who had some internal discussions, analyzed market, and came to some number without calculations, without I mean they did calculate, but the final result was not the direct outcome of some mathematical calculations. This is the mix of mathematics and just feelings of people. And when somebody sets somebody strong like KPMG in this case sets this equity risk premium, and this is again this is quite old, it's for 2016, you would need something newer, but you can find something like this. You can check equity risk premium included in reports and equity reports of investment banks, and in many cases you can just directly use this information without any further calculations. Why without further calculations? Why we don't believe in calculations, although we discussed the theory, and that theory had formulas based on data. I will show you that in our beta calculations. So for Russia, it could be something like this. We could analyze that from just from the market data. I collected 3 years ago. I collected data from the market, calculated my result for the period between 2001 and 2016. I got 8% as equity risk premium. Different calculations, different scenarios give me something between 8 and 9%. But again, it was a bit old information. I didn't update this slide. Today, it would be like between 6 and 8%, I believe. In most versions of calculation you use, you'll get between 6 and 8% as your equity risk premium. Okay, so this is our equity risk premium, and the last parameter in our formula is beta. Beta, as I said, is a correlation between changes in market return and return of a company. So the formula looks like this: it's covariation of return for the security and return of the market prices over squared standard deviation. It looks like a complex formula, but actually mathematics here is the easiest part of the question. Because, okay, we have Excel formula for covariation, and we actually have just a mathematical formula for covariation. You can build a model, you can calculate it. It will take some time to create this model, but after you create it, you can use it very easily. You just collect information about the prices, and you'll get beta for any company. But you'll see that the question isn't that simple. Let's begin not with calculations, but with the idea of beta. So beta shows you how sensitive is the company, the share, to general changes in the market. If beta is equal to 1, that means that if the market changes by 1%, if the average market index, let's say market index, changes by 1%, then probably our company, our share, will also change by 1%. If beta is equal to 2, that means that when the market changes 1%, our share usually changes about 2%. It's twice as sensitive to changes in economy and so on as the general market. So you can guess that companies with higher risk have higher beta, and, for example, luxury goods. Luxury goods is something that, on average, not always, but on average, are very sensitive to what happens to the market. So if we have a crisis, then demand for luxury goods will drop, and luxury companies, luxury firms will lose their profits much faster than the other companies, and vice versa. So luxury goods will probably have beta higher than 1 and just high beta. If a company is a growth firm, if it expects that if its value comes from expected growth of its business, then the beta will be higher again, because if the market lost something, then for many years of expected growth, this firm will lose much more, and it will lose more value. So luxury companies, high-risk companies, growth companies have higher beta. If we are a cyclical company, which means that in good times we do very good, in bad times we do much worse than the other companies, or at least the same, we have the same problems as the market, then beta will be higher. If we are a non-cyclical company, which means that we do better in bad times, maybe because we provide cheap services or goods, and people prefer better services or goods in good times, but during the crisis they come to us. So we can be non-cyclical company because of that, or because of other things. Maybe our costs will fall much faster than our revenue during the crisis, and so on. So non-cyclical company has a lower beta, high cyclical company has higher beta, and so on. So generally speaking, beta is a measure of sensitivity and risk of a company, and for riskier and more sensitive to the general economy companies, beta is higher. And with that, we can go to calculation of beta. We will try now to calculate beta for Nike as an example, just based on market information. But before I go to the model, I should tell that there is another version of beta. The beta calculated with this formula, covariation over squared standard deviation, is what we call raw beta, unprocessed, unadjusted beta. So for analysis, for valuation, in most cases, people use what they call adjusted beta. And adjusted beta has a very simple formula. Adjusted beta is equal to 1/3 plus 2/3 times raw beta, which actually means that adjusted beta is always closer to 1 than raw beta by 1/3. So if I had, for example, raw beta 1.3, then adjusted beta will be 1.2. If raw beta was 0.7, then adjusted beta will be 0.8. Why that? Because analysts, while they have been using adjusted beta in their analysis, they saw that in most cases, if a company has historical beta with large difference from 1, then they tend gradually go toward 1 in the future. And that's why they created this adjustment. They calculate adjusted beta that will always be closer to 1, just to for account for this observation. Okay, so we usually calculate raw beta based on historical data, and then we adjust it, right? Let's go and look at Nike. So I collected data for Nike. Again, I didn't update that because nothing changes in the principle. So here I collected information for 120 months, I believe that, yes, for 10 years. It's monthly information about price for Nike and changes in this price, and S&P 500 index and changes of this index. And of course, change in price of Nike means return on your investment in Nike, and changes in price or in value of index is return on your investment in index. So then we calculate all standard elements of our beta calculation, which is standard deviation for Nike, standard deviation, was it for Nike? No, the first one is for the index. Standard deviation for index, square standard deviation, then covariation between what we calculated for Nike and index, and we calculate beta as covariation over square standard deviation, right? What's tricky in this calculation. What period should we use to calculate beta? Well, we all agreed on the formula. The formula for beta is what we discussed in our calculation. But what period should we analyze? And again, if you use icon, and this is another example why I sometimes I don't like using icon, just blindly using icon, because in icon you just get beta. They don't explain you how they calculated beta. They don't show you possible other values of the beta with the same formula but with different data. And standard approach for icon is that they calculate beta based on monthly returns for the last 5 years. So it's exactly what we would get for Nike for this period in icon. We would get beta 1.46 or adjusted beta 1.64. That's with this period. But what if I analyze not last 5 years, but last 6 years? And we get adjusted beta 0.7. What if I take 10 years and we get adjusted beta 0.87? And the difference between the first one and the second one, 64 or 87, is huge, because we applied this beta to equity risk premium, and that changes our discount rate, our required return, a lot. And in the beginning of the lecture, we discussed that changes in discount rate has very large, big influence to the valuation that we get. So this is an important question for us. And with this range of possible betas, by the way, all those betas are calculated based on the same formula, so you cannot prove that the first beta is better than the second beta. There's no theory that can prove that one is better than another. So we have this range, and that raises a question: should we actually calculate betas for companies if those betas have such diverse values based just on our selection of data? And one of the answers that people use is no. We will not use those betas, because yes, companies have different periods in their life. Every company for different periods can show you very different calculations for betas. These numbers are unstable, but we calculated betas not because we wanted to analyze 5 years of history or 10 years of history. We're actually not interested in the history at all. We're interested in the future. So for the future, we need something more stable than this beta calculated for one company. And so instead of calculating beta for specific share in our analysis, in many cases, we use industry's beta. Industry's beta can be calculated as average beta for many companies in the industry where we work. And the idea behind that is that, look, beta reflects sensitivity of a company to changes in the economy. Beta does not reflect individual risk of the company, right? But if beta does not reflect individual risk of the company, then probably this sensitivity of industry will be a better estimation of our sensitivity. So that's why in the analysis, in calculation of required return, in most cases, people don't calculate beta for a company and instead use beta for the industry in which this company works. And we have a good source of information for this industry's beta. I recommended last time, I recommended you using Damodaran as another version of lectures, but actually Damodaran, he's a professor, but he managed to establish a good source of information on his website. This information is used in valuation by many analysts, and even I had I saw several examples where, for example, in Russian government regulations related to valuation, there were requirements to use industry's beta from the Damodaran website, although it's just a website of a university professor from the United States, and this is not an official source. It doesn't look like a very reliable and formal source, but his status and image actually is good enough to use his betas and his calculations even for very formal valuation, very formal analysis. What if we estimate 1 year required return? As far as these betas are not for monthly returns. Half of one. No. Returns are always, both in my calculation, in these calculations, they are always annual returns. We just used changes from month to month, but everything we do. You mean in my calculation, in my model? In my model, yes, I calculate just month returns because it doesn't matter. It doesn't change anything. If you use, instead of monthly returns, if you use annual returns, you will just use power of 12 for all numbers, but the final result will be the same. I mean, covariation will be the same, and the relations between covariation and standard deviation will be the same. So the calculation will not change. In fact, in practical work, we use not betas calculated for the company, but instead we use those industry's beta. And this is our example. Yes, we discussed this Nike. And the last question about beta is, okay, beta shows me this sensitivity between what happens to the market and what happens with my company. But what happens to my company, the changes in its profit actually depend heavily not just on its general sensitivity to the market. Yes, about the question. Yes, you can use the Damodaran's beta for all horizons. So there are two factors behind this sensitivity. First is this nature of industry. if I work in high beta industry, my beta will be probably high, and so on. But there is another thing. Look, let's look at 3 different cases. I have a company, or I have 3 similar companies. And for the first company, I have just equity as their source of finance. For the second company, I have financial leverage equal to 2, which means that 50% of its capital is equity and 50% of its capital is debt. And this is a loan with 15% interest rate. And the third company has 20% of equity and 80% of debt. Those 3 companies invested 1,000 rubles and receive an EBITDA. First scenario is a good economy, high market, and they receive 200 as EBITDA. And the second scenario is bad market, some crisis maybe, and they receive 100 rubles as EBITDA. What happens? Look, the first company has 0 payments to the bank. So for their investment, they have, for the first scenario, 20% return on investments. And for the second scenario, it's 10% return on equity, say. So the difference between first and second scenario is 10%. The second company, 50% of their capital is debt, so they anyway should pay the 75 rubles on this investment. So for the first scenario, they have remaining 125%, 125 rubles on their 500 rubles of investment, and that makes 25% return on equity. For the second scenario, return on equity will be 2.5%. The difference between good and bad scenarios is 27.5%. And the third company will have 40% as return on equity for the good case and minus 2% for bad case. So the difference between good and bad scenarios is 42%. So for the same industry, for the same beta, as we expect this beta from industry, they have completely different level of risk. So actually, betas for these 3 companies should be different, right? This is another factor that we account for in beta. The first was industry, and the second is leverage. Why 27? Oh, you're right. Yeah, 22.5. Yes, it was 22.5. Because I can calculate without Excel. I've forgotten how to do it. Okay, so we can see that betas or sensitivity of those companies depend on their industry, that was in their EBITDA, and from their leverage. And to account for that, we calculate what we call leverage beta as compared to unleveraged beta. So beta of any company depends on the level of its leverage. And this formula, you should actually try to remember the formula, because in different exams you'll be asked to apply this formula. On CFA exam, you will be asked to apply it. That's for sure. And just to use it quicker in your calculations. So the leverage beta is equal to unleveraged beta times 1 plus 1 minus tax rate times debt over equity. And vice versa. Unleveraged beta is equal to leveraged beta over the same construction. So we calculate this leverage beta if the initial beta was unleveraged. But all companies that we use in calculation of beta, they all have some level of some leverage. So what we do actually in our analysis, and what's done for these tables, for example, for the Damodaran tables. First, we calculate beta for all those companies. Then we calculate, they have some leverage. From this leveraged beta and with their level of leverage, we calculate unleveraged beta, which is kind of baseline for us. That shows us how sensitive are companies without any debt to changes on the market. And then from this baseline, we calculate our beta with our leverage, using our shares of debt and equity. So this is the complete procedure how we calculate beta for our analysis. And for example, for Nike, we can use here Nike leverage is pretty much equal to industry leverage. It was 1.17. Industry debt to equity is about 10%. So the difference isn't that big, but we can still recalculate this industry level to the Nike level. The first step, as I said, to calculate unleveraged beta, and then Nike's leveraged beta. So this is the whole process of calculating beta. And now with that, we discussed all three parameters of CAPM. We discussed how we decide about risk-free rate we use in our calculations, what is equity risk premium for us, and how we analyze betas for companies. And you should take easy the fact that in many cases we didn't have a straightforward, strong, hard formula that we can use to calculate discount rate. This is the nature of this rate and this approach. Yes, we have some range of possible calculations of possible data that we can use, but with this idea, of CAPM, we can build a robust principle that we use in our analysis. And even if you make mistakes in your calculations of required rate of return, an absolute number for the required rate of return isn't very precise, but at least from company to company, you have a consistent approach which you use to compare those companies, compare those available investments, and so on, and choose the best investments. So as a principle, that works, but unfortunately, that doesn't give us one precise number. So, to sum up, CAPM algorithm. First, we choose the risk-free rate. Basically, it's 10 years government bond. Second, in Russia, we subtract country risk premium because we expect to see this country risk premium inside our equity risk premium, not inside the risk-free rate. Third, we estimate equity risk premium. It can be, and that's again 7 to 9% for Russia. It's a bit old. Now it's between 6 and 8, I would say. And we can use calculations to prove it, but we can also just use it as something that comes from market as some opinion of the market. Maybe we cannot calculate the precise number, but we can apply it to our valuations. No, inflation here is inside our, if we subtracted country risk premium from government bond yield, then the inflation premium is there, because the baseline for our calculation risk-free rate, if we calculate risk-free rate from yield to maturity of government bonds, then government bonds have three parts: risk-free rate, inflation premium, and country risk premium. We subtracted country risk premium, inflation still is there. And that means that for Russia, risk-free rate will be not like 2%, but something about 4%, because it's risk-free rate for rubles, including inflation. The fourth step, we choose the most appropriate industry and find unleveraged beta for that industry. By the way, in those Damodaran's tables, he publishes both leveraged beta with average level of debt for this industry and unleveraged beta. So you can use unleveraged beta from there. And the last step, we apply companies' debt to equity ratio to calculate the company's beta. And here we are, we have CAPM formula. The CAPM formula is the basic and the most fundamental principle used in all calculations of required rate of return. But there are problems with this formula, and those problems not just problems with data. Yes, of course, we have a lot of issues with how we select data for our calculations, but we also have some more theoretical issues. And by the way, yeah, I've forgotten about this example. A very important thing about CAPM as a principle. CAPM wasn't created, or wasn't introduced to the market analysis, to the valuation recently. It's quite an old method. And when CAPM became popular, and it was like 30, 40 years ago and older, that time, the responsibility of this calculation in your general valuation model wasn't that big, because look at this example. In 1990, risk-free rate in the United States was 9%, and equity risk premium was about 4%. And in 2017, the risk-free rate was about 2%, and equity risk premium was about 6%. So 30 years ago, CAPM model was responsible for less than 1/3 of your required return. And now CAPM model, I mean beta, equity risk premium, is responsible for 3/4 of your required return. So the price of any mistake, of any error today in your calculation is much higher than it was 30 years ago. So today, the situation when it's not enough to just straightly use CAPM for calculation, this is something that happens more frequently. So what people have instead of CAPM, or in addition to CAPM, to account for this higher responsibility for this method. Basically, they introduced several multi-factor models to calculate required rate of return in a different way. And the idea of those multi-factor models, multi-factor models is that, look, in CAPM, we start from the idea that the only thing that influences required rate of return is some one parameter of general sensitivity of the company to expected market return. But what if actually there are other factors, there are parameters, other parameters that influences the results for the company? What if we cannot just use this one beta and just use expected return for the market, for the general market? Okay, we can build a more sophisticated, more complex model. And that starts with the general idea of arbitrage pricing theory. With arbitrage pricing theory, we said that there are several factors, not just equity risk premium. There can be many different factors. And required rate of return is a combination of those factors and sensitivity to those factors. And you can easily see that CAPM is an instance of arbitrage pricing theory with just one factor, equity risk premium, right? So we have risk-free return plus sensitivity to equity risk premium. Our sensitivity factor is beta, and the factor is equity risk premium. What if we have more factors? The most well-known model is Fama-French model. And with Fama-French model, we introduce two other factors. So with this idea, we start with the risk-free rate, just as with CAPM model, but in this case, in a Fama-French model, they use risk-free rate for T-bills, so for very short-term treasury bonds or treasury bills. And then we have three parameters, just like in CAPM. The first, beta for market, and as the factor we use equity risk premium. In fact, it's equity risk premium. Firm of Range called the concrete example of equity risk premium. They used weighted average equity index. For example, it can be S&P 500 in excess to 1 month's treasury bills. But this is exactly what we called in the previous example in Compare, we called equity risk premium. So beta to the market, or sensitivity to the market, times equity risk premium. Second, beta for size times what they called small minus big, SMB. And small minus big is a size factor, and this is the average return on small cap portfolios minus average return on large cap portfolios. And on average, we understand that smaller companies has higher rate of return because of higher risk for small businesses. So we expect that we'll have this higher return for small companies. And this beta, in this case, shows us how small is this company, or to what extent this company behaves as a small business or as large business. Does it capture this difference between small companies and big companies? And the third parameter is HML, high minus low, and this is the average return on high book to market companies minus low book to market companies, which is the difference between value companies and growth companies. And again, we understand that value companies should have lower rate of return than growth companies, because growth companies has higher risk. So this difference is the difference for growth, and beta for value, this beta that we use for HML, shows us to what extent this company behaves, this company's stocks behave as growth stock or as value stock. So this is a bit more complex model, and this model can capture sensitivity to the market, how small or big is this company, and how is this company is a value stock or growth stock. Firm of Range is the most known example of arbitrage pricing theory. I mentioned Pastor-Stambaugh model, and if you go into sit for CFA exam, you should use you should learn Pastor-Stambaugh model as well, but we won't use it in our course just because it's even more complex, and even Firm of Range is very hard to use in practice. So it's more a theoretical thing to understand how actually the market works, how this required return can be built and can be analyzed. And the last and very practical approach is build-up model. With build-up model, we just start with risk-free rate, and then we say that we won't use any betas, any detailed calculations. We just use several risk premium. And for this build-up model, there are usually two standard premia. So we calculate required rate of return as risk-free return plus equity risk premium for the market plus size premium. Usually it's like between 2 and 4%. and specific company premium. And this specific company premium can be, for example, because we believe that this company is especially risky or especially stable and so on. It's usually between 0 and 2% or minus 2%. And this is what people use in their calculation. Later, when we'll be talking about private companies, we'll add also liquidity premium to this calculation. But for public companies, it consists of these 4 elements: risk-free, ERP, size premium, specific company premium. And this is what you'll see in many real professional equity research reports, this build-up method. I'll skip the statistics. And the final idea. Sometimes we need some calculation, some value for our required return on equity, but we don't have time, or we don't have access to data to calculate equity risk-free or required return on equity based on CAPM model or even more sophisticated models. So in these cases, sometimes we can do it very simply. If we know cost of debt for a company, that we can start from a very simple idea that cost of equity is always higher than cost of debt, because shareholders risk more than debt holders. So we have to add something to the cost of debt, and the cost of debt is yield to maturity for the company's long-term debt. And the difference between cost of debt and cost of equity in many cases falls between 3 and 5%. So if you know yield to maturity for company's bond, you can add 3 to 5% to that and use this in your valuation as cost of equity. This is a very simplified approach, but it works. And this is the last thing with our required return on equity. Let's stop for today, and the next lecture we'll discuss general free cash flow valuation. We'll discuss cost of debt, weighted average cost of capital, and all the things that that are behind our income-based approach in valuation. So that's it for today. See you next Tuesday. Yes, you'll have a quiz, but as I said, I'll publish the quiz tomorrow morning. And all the Excel models I used, I will put them on LMS, but not today, because I must go now. I have 2 hours drive to my home, and tomorrow morning I'll do that.